Yeah. A lot of times you buy houses. I know a girl bought a house for 105, had it appraised a couple weeks ago. It's worth 80 now. It's in Morgantown, and she's having a problem. She called me about a short sale. She said, would you help me with the short sale? Immediately, I'm like, no habla inglés. Yeah. Now, here's one of the downsides to a short sale, and maybe we can get Eli's opinion on this. A lot of times, one of the things that happens is, if you have a car repossessed and you owe $5,000 and they take your car to the auction, they sell it for $3,000, you still owe the other $2,000. Yeah. So in a short sale, you owe $100,000, you get the bank to take 90. They may come after you for the deficiency and go to court and say, yeah, we'll take the 90, but Raymond, well, you're still signed the contract for 100. You owe us the difference. And they will get a judgment against you. That's called a deficiency judgment that they can seek. But here's the big kick in the ding-ding for that. That's called mortgage relief. That's treated like ordinary income. So not only do you get hit with the deficiency judgment, you get hit with the taxes on that money as if you earned it from McDonald's. So one of the things you typically do on your initial cover letter to the bank is so-and-so, here's our offer, and we want a waiver of a deficiency judgment. As part of the negotiation of the deal, we want you to take the 90, but not go after Raymond for the 10. Did you guys seek a waiver, or did they offer a waiver? Okay, because technically what happens after you get the deficiency judgment, then you file BK. All right? You've already got foreclosure. What's bankruptcy? Might as well flush this whole thing and start over. Right?
Are you getting ready to say that Congress made it exempt for the forgiveness to be exempt from income?
They did do that, didn't they? In the CFPB, what's his name? They made that exempt. The forgiveness portion. So that was with the laws, but we haven't got to the Dodd-Frank Act yet, which, thank you, Jonathan. The Dodd-Frank Act came about, and one of the things is they actually put in there a forgiveness clause for this. Hey. So the Dodd-Frank Act was a reform that created this thing called the Consumer Financial Protection Bureau, which, when you spell that all out, creates big pain in your butt. Because these are the guys that put in a whole bunch of rules, and we're going to do a whole chapter on the CFPB and RESPA and the truth in lending, and it is so confusing that when you get so confused, you don't even know you're confused. That's how confusing it is. You talk yourself right back into going, hey, I know everything. And then you realize, no, I'm so far off, I don't even know anything. Like I told a guy the other day when he was talking about voting, I said, you're so stupid, I don't even know where to begin to help you. That's how far off you are. Homeowners insurance, this is something that's required. There are two types of homeowners insurance. There is what they call this thing called a cash value, or a cash policy, and a replacement policy. Which one of these policies takes into consideration the depreciation of an item? Everybody says that. He said replacement. Everybody says that. I don't know if it's because I say it wrong and I can't get you to, but the actual answer is cash. Cash policy takes into account the depreciation of an item. Because you paid $500 for it 2 years ago, your TV gets stolen last night. They said, oh, it's depreciated, it's now worth $200. They give you the $200 cash. In the replacement policy, you bought it $500 2 years ago. It gets stolen tonight. They pay you to replace it of $500. Well, wait a minute. If there's a policy that pays me to replace my stuff, why would I buy a cash policy? Because the premium, is the word, is cheaper. All right? So I'm making up numbers. The cash policy may only be $50 a month, while the replacement's $100 a month. So your premiums are cheaper. Now, I'm sure every one of you in here, and those of you listening at home, have got your bank accounts labeled insurance premium policy difference, right? Because what you're supposed to be doing is taking the difference in your monthly premium, putting it in a bank, so that when your TV gets stolen and they give you $200, you need that $300 out of your pocket. You go to that bank account, take $300 out, and go buy the TV, right? You guys are all doing that, right? That's what happens. The money that you save in the premium is supposed to offset the depreciation that happened. If you are really smart and you are an actuarialist, you can do this math and find out which one's easier. What zip code do I live in? What's the crime rates? Therefore, the odds of my TV getting stolen are this, based on how many months, yada, 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 which is all they do with health people, by the way. Raymond wants to buy a health policy. Well, geez, he's old, he's overweight, smokes cigars. He probably won't finish this recording. As opposed to one of you young guys, Bryce, young, thin, good looking. I hate you. All right? So my insurance policy is going to be more than his would, because that's what they do. Oh, figure in these factors, yada, 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 blah, 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 blah. So they got to get that amount of money out of me quicker than they would, say, him. How this happens in the housing world is you go out and you've got an $80,000 house. You get an $80,000 homeowner's insurance policy, you're 100% covered. You have an $80,000 house and you buy a $40,000 policy, you're 50% covered, right? So now something happens to your house, you make a $5,000 claim. On the example where you're 100% covered, how much does the insurance company pay you? $5,000. On the example where you're 50% covered, what do they pay you? $2,500. Where does the other $2,500 come from? The difference in those two policies, because the policy that's 50% covered is less than the policy that's 100% covered. So the difference in the premium is where you save the money to cover that difference when you make a claim. That's how it works. Now the problem is, in this example, that'll never happen in the real world. You cannot get a $40,000 policy if you owe $80,000, because the lender will make you get at least enough to cover their note in case the house burns completely down and they want reimbursed. All right? So you can never get a 50% policy if you've got a 80% loan. You need an 80% policy to cover them, make them whole. Now there's one other thing called a clue. So when someone tells you to get a clue, this is what they're talking about. No. Clue is called the Comprehensive Loss Underwriting Exchange. What Clue is a database that all the insurance companies use so that they can track payouts on properties and owners. That way, Josh can't have a roof damage, call Flo from Progressive and go, hey, I want you to pay my insurance policy, and they pay him for a new roof, and then he forgets and gets mortgaged with the general and goes, hey, I want you to pay my roof because I had a damage. No, wait a minute. We looked on the database called Clue, and it says you were paid out 2 months ago by that other insurance. We're not paying you out. That's what Clue is. Not that Josh would ever do that. I'm just joking. It's a different Josh. Josh Whedon, the director. So that's what Clue is. It's nothing more than a database so that you can't erroneously try and make two claims. We use this between buyers and sellers. When the new buyer comes in and says, hey, I need that roof has been ID'd as damaged, And then all of a sudden they're like, oh, we paid the seller to have the roof replaced 8 months ago and he never did? No, we might want to talk to the seller for an insurance fraud. There's one other type of insurance called flood insurance. Flood insurance is only underwritten by one person, FEMA, the Federal Emergency Management Agency or Administration. Unless you live in New Orleans, then it's friggin' emergency my ass. Because they took so long to get there. All right? But then again, how do you blame them? You build a city called New Orleans in a bowl that sits below sea level and then got mad when it flooded. And what's even worse, you put all the reserve generators in the basement of those buildings instead of the roof. But I'm not bitter. I don't live there. And then what they do? They rebuild it again right in the same spot. Yeah. It is fun to be there. So flood insurance, if you're in the floodplain, you will be required to get flood insurance on your policy. There are ways to get out of that. You can have a surveyor come and they can shoot an azimuth to show that you're certain so high above your house sits so high above the floodplain. You can get an exemption letter, send that off to FEMA. They will send you a certificate that waives you from that, and then you don't have to buy the policy. Now, the problem with that is it's about $800, which is about what flood insurance costs. But if they're wrong and you are in the flood policy, then you got to buy the policy anyway. So you kind of want to hope you're right. Flood insurance covers overflow or inland tidal waves. The overflow of inland or tidal waves, maybe I should say it that way, not inland tidal waves. That would be hard to have. The unusual or rapid accumulation of water runoff of surface water, like the Martinsville, 5-6 years ago when it rained so hard in Martinsville, flooded all that stuff. Mud flows, landslides, mudslides, the collapse of land along the shore of a body of water like a dam. If I were you, I'd know what flood insurance covers. Kind of a hint. All right. That is chapter 12, all 73 pages of it. A lot of information. There is a lot of questions you can be asked and a lot of math in here. All right? I would suggest that you probably do the book, the online quizzes. I try and get to, the Dearborn stuff, anything that you can do. Heck, you can even Google math questions, and I'm sure there's stuff you can find. All right? That's it for now.